Okay, so the current ratio is the liquidity ratio.
Yes. Okay, this was 1.
C.
C. Okay. Right, so yeah, first thing to obviously describe is its focus. So the current ratio is a liquidity ratio. It shows us it shows current assets divided by current liabilities. Do you agree? Okay.
So it focuses on the assets and liabilities.
Current assets and current liabilities. And gives a measure of the firm's or the company's ability to meet short-term obligations. Okay, let me just look at the question and see if we can maybe add anything else. Okay, so they said, explain the importance. Okay, so it's important to make sure that we can meet this obligation. That's something that you definitely have to describe there.
Okay, so it focuses on the current assets and current liabilities of a firm.
Good, full stop.
Yeah.
This measures the company's ability to meet its short-term obligations. Okay, and let's comment about the ratio. So a ratio bigger than 1, okay, we can look at that. Okay, so this measures the firm's ability to meet its short-term obligations. Okay, and then we just need to define how to read or interpret it. So a ratio that's greater than 1 is positive. Okay, it's good. Okay, that represents good liquidity. Okay, because numerator bigger than denominator. Okay, so I'm just adding a bit more in terms of the interpretation because it's 4 marks. I don't know if 4 marks will be awarded to one definition. That seems a little bit much. But yeah, that's what they're giving. Okay, so explain the importance to the business of the current ratio. Maybe importance, you could also say we need to monitor the ratio year on year to see if we still have liquidity, or if we still have good liquidity maybe. Okay, I think that's it. Okay, then they give you additional information. They say the directors of M Limited have calculated the current ratio to be 8.87. That's very good. Okay, that means you've got 8 current liabilities. No, 8 current assets to 1 current liability. They regard the ratio calculated to be too high and are considering repaying debentures. That's interesting. So they're saying it's too high. It's probably because they maybe want to use those resources elsewhere. Because if you've got lots of assets and they're just sitting there, having 8 assets to 1 liability is a little bit excessive. Do you agree? Okay, having maybe 2 or 3 assets to 1 liability, that's safe. Okay, but having 8 could be seen as excessive. That's probably what they're doing. So number D, they say discuss the effect of this course of action. Okay, so if we had to repay some of our debentures, okay, this is what they're saying. They say considering repaying the debentures. Okay, what effect is that going to have on the working capital? Okay, so question 1D, D1. Okay, so we first need to identify what working capital is. So W, working capital is current assets minus current liabilities. Okay, so that's what it is. When I look at the current liabilities, I'm checking what the business has in terms of assets to what the business owes in terms of liabilities, but short term. Okay, so working capital is looking at that. Okay, the short term assets and liabilities. Okay, so here they said discuss the effect. So they said the directors of M Limited have calculated the current ratio to be 8.87. So we can say current ratio is 8,87 to 1. Okay, this indicates 8,87 current assets to every current liability. If we, what did they say? Repay. Okay, so they say if we repay debentures. Okay, what is the effect going to be? That's what we're looking at. Right, well, first of all, we need to understand what a debenture is. Okay, so what is a debenture? Do you remember?
So let's see what you've written.
Yeah, so the current ratio is 8.87. What does that indicate? 8.87 current assets to every current liability. Right, if we're looking at repaying debentures, we obviously need to know what a debenture is, right? So that's what we're trying to establish here. Okay, because we're looking at the effect of. Okay, so if you know what something is, then you'll know how to apply, okay, the theory.
Okay, if we do repay debentures.
Yeah, so that's what we're discussing. So we're looking at what's going to happen if we repay debentures. That's what they're saying. So I'm just asking you in terms of debentures, do you know what it is?
It's like small little loans.
Exactly, but non-current or current?
Current.
Non-current. Okay, a debenture is a big loan that's broken up into smaller pieces. Okay, so everybody can buy, or inverted commas, buy a piece of the loan. Okay, so what are we going to do? Well, we're going to debit the debentures, bracket, non-current liability decrease. Okay, and then we would have credited bank, because they say repay the debentures, bank / cash, depending on what we're using, asset decrease. Okay, so that's the accounting entry, because they're saying discuss the effects of this course of action. So what am I going to do? I'm going to process that repayment. So if I repay, so I said if we repay debentures, we're going to do that. We're going to debit debentures, we're going to credit bank or cash, depending on what account we're going to use. Okay, so what's the effect going to be? Well, comma, we're using
the effect of this.
Yeah, what is the effect of this on working capital? Okay, so we're using cash / bank brackets current assets to pay a non-current liability. Okay, the current assets will decrease, and therefore the current ratio, not the current ratio, the working capital, hey? That's what they said. They said discuss the effects of the working capital, yeah. So, and therefore the working capital will decrease as well. Okay.
So basically the effect of this will decrease current assets and decrease working capital.
Yes, okay, because you're obviously using the cash to pay off the debts. Okay, the debenture. it'll decrease current assets, therefore it'll decrease working capital. Okay, because of what we said there, debit credits. Got that. Okay. Next bit of theory. Discuss the effect of this course of action on the return on capital employed. We need the formula for that. Can you pass me the textbook? Or you can look at your notes. The notes will have it, so that's fine.
Return on capital employed, profit for the year before interest and tax, over capital employed times 100.
Okay, we need to write that down. Okay, so ROC equals before interest divided by capital employed. Okay, just be careful with this because capital employed has a formula, so it's highlighted. Okay, what is capital employed? CE equals total assets minus current liabilities. Okay, so they're asking us about the effects. So same thing applies again. We can write this down. If we pay debentures, okay, what are we going to do? Debit, debentures, credit, bank. Okay, we know what the formula is for ROCE. Then we just need to look at the effects. Okay, that we can discuss. You can just write that bit down and then we can look at it. Okay, so you've got that. We're looking at this effect. We know that capital employed, which is the denominator, is made up of total assets minus current liabilities. So if I'm going to be repaying my debentures, I'm going to affect a non-current liability, so that's not going to affect the formula. Do you agree? Okay, I'm going to credit the bank. Is bank an asset? Yes. So this is going to be affected. Total assets will be affected. So let's write that down. If we pay debentures, okay, well, I wrote that down already. We can just say the effect would be a decrease in bank, which is a decrease for total assets, which will then reduce the capital employed. Okay, so that's what we've got. If I credit the bank, I'm decreasing the bank. If I decrease the bank, it's going to affect that, the total assets, because bank is an asset. If the assets are going to go down, that means that the capital employed is going to decrease. Okay, so what does that mean? That means you've got a smaller denominator. If you've got a smaller denominator, what happens to the ROCE?
Decreases.
It will get bigger actually, because now you're dividing by a smaller number. Okay, so let's say if I have 100. 100 divided by 50 is 2. Okay, so that's 50. If I make 50 20, 100 divided by 20 is 5. Okay, so that means the answer gets bigger. Okay, that's the last bit. Okay, so if capital employed increases, reduces actually, other way around. If the capital employed reduces or decreases, let's use the word decreases, comma, this will increase the ROCE. Okay, because that's the denominator. So if you make this smaller, because bank is affecting the assets, this answer is going to get bigger. And that's the effect. Okay. Okay, the last one is E, 1E. E says, advise the directors on whether they should repay debentures early. Justify your answer. Okay, so that's just theory. It's for 4 marks, so let's try and get 4 points. Right, do you think the director should repay their debentures early?
Yeah.
Why?
Less interest.
Correct, that's 1 point, so good. If the debentures are paid early, comma, the company will reduce its liabilities, which will save on interest expense. Okay, so obviously the longer you hold the debentures for, the more interest you're going to obviously pay. Okay, so that's good. So if I pay early, I'm going to reduce the liability, which will save interest. That's fine. Okay, it doesn't increase the ROCE. It does increase the ROCE, return on capital employed. So that could be a reason why we would repay. Okay. If we pay early, comma, we will increase the ROCE, bracket C, details above.
Okay, I can't actually write.
Can you? You can't. Oh, okay. Well, then just say because of that.
If we pay early, if the company pays early,
we will increase the ROCE because total assets are reduced when paying the debentures. Okay, so it's basically just using what we did here.
So it will increase the return on capital as
total assets are reduced and capital employed decreases. Okay, so that's just basically using that. Okay, we can't use 1 to support this. Why? Because in 1, what happened to working capital? It decreased. Yeah, so you wouldn't want working capital to decrease. That would be a reason why the directors shouldn't pay. Okay, you're just saying advise the directors on whether they should pay the debentures early. Justify your answer. So we're going with they should pay early. Why? They're going to save on interest, they're going to reduce the liability, and they're going to increase the ROE. Another reason could be in terms of debentures, we can say it gives a good impression, so you can maybe take out more debt later. So paying off debt bracket debentures gives a good impression of the company's management. Okay. If lenders trust us, comma, the business can get more debts, can get more debentures in future. The business can raise more debentures in the future. Okay, I think that's enough. They said 4 marks. I think maybe if you want to, you could maybe split the first one into 2. Okay, you could say, well, the first thing is we're going to reduce liabilities. The second thing is we can save interest. So I think in total you've got 4 points there. Okay.
Okay.
Right, that's the end of that one. Okay, now we can start a new question. Okay, so question 2. Remember, exam technique is important. With questions like this, I need a template. Okay, you need a structure. Okay, you need the format. So what are they asking you to do here? Look at the required first and then go back to the question.
Okay, prepare an income statement for the year ended 30th of June 2017.
Good.
Use the template given below for your answers.
There's it. They've even given it to you. Okay, so we're going to stick to that. Okay, we're not going to use the one in the textbook. We're going to use the one on the question. Okay, and the second part?
Prepare an extract showing the current account section of the statements of financial position.
Okay, so only the current account section. Right, so let's show that. Obviously, can I just put this here and then let's copy this template?
I'm just going to write it on the...
Are you going to write it on there? Okay, that's fine. I'm going to have to type it out. So you've got 2 columns, income statement for the year ended. Okay, so that's obviously the heading. Then you've got revenue, cost of sales. Closing stock, gross profit. Okay, that's it. All I do need to do here though is I need to put totals. So I obviously need to put a line here for gross profit. I need to put a line there for profit from operations. And one over there as well. Okay, in terms of the financial position, I'm just going to take an extract of what we had here earlier. Okay, there's it. I'm just going to write this down. And they only wanted current, so delete all the other stuff. Okay, so that's the template, that's what you need to do. Okay, so now what do? We go to the question and we read it line by line. So what is the first bit they said at the beginning?
It's a bank loan, so that doesn't go in our income statement.
Yeah, but the beginning, the paragraph?
Bayless Limited is a private limited company trading as a wholesaler of garden equipment. The draft trial balance at the 30th of June 2017 has been extracted from the books.
Okay, good. First line item?
Bank loan, so don't go in anywhere.
Why?
There's no current asset.
Yeah, it's a current liability. Good. Next.
Bank, 14,000 credit.
So if it's a credit?
It's a bank overdraft.
It's bank overdraft. Doesn't go here either. Next.
Okay. So that's actual liability. Cash, 650.
What is that?
Current asset.
Correct. Cash. Bracket 650. Next.
Director's remuneration. What does that mean?
Director's remuneration just means it's a fancy word for director's salary. Okay, how much is the director's salary? Remuneration is what you pay your employees.
53,200.
53200. Okay.
So it will go here.
Yeah, so working. We might have to adjust it, we don't know. Maybe you should use pencil just in case. Alright, you can always write in pen afterwards on the answer.
Fixtures and fittings is a asset.
What asset?
Current asset.
Non-current. It's long term.
Okay. So that won't go anyway. Cost and provision.
Yeah, that's part of the statement of financial position or PPE notes.
Okay. Interest paid is an expense.
Which other ones did you tick?
Motor vehicles and land.
Okay, same thing, yes.
Interest paid.
Interest paid. Interest paid? What is interest paid?
An expense.
Good. We need to put that here. Okay. Where would it go? Finance costs.
Okay.
Interest is part of finance. Use pencil just in case.
But you're doing it on here, so it's kind of right.
True, but what happens if there's not enough space and you need to add something? Because it's easy for me to change what I've got, eh? So that's the only, because you're using the answer. The thing is, you can't unless you rewrite this if there is adjustment that needs to be made. Okay, it might be an easy one. I know you like being neat, so the thing is, you don't want to have crossing out and all of that all the time.
Okay, what was this?
I don't know. What was this?
5920.
5920. Okay, there we go. We've got another one. Okay, go back. What else do we have? So you've read that one.
Inventory at the 1st of July 2016.
Do we need that?
Yeah.
Why?
To open the balance.
Exactly. Okay, this is already a clue that this is periodic. Okay, how much?
62,400.
62,400. Okay.
So this is perpetual.
No, periodic. Periodic uses opening stock, closing stock purchases, right? Okay. Periodic. Periodic requires a calculation of the cost of sales.
Okay. Office costs.
Yes, that's an expense. How much?
18,330.
18,330. Okay. Yeah, just double check the amounts just to make sure we are reading the right figures.
Okay, property costs.
Good.
21,940.
940. Okay. 21,940. Another expense. Next.
Purchases.
We need
268,200.
268,200. 268,200.
Retained earnings.
Yeah, retained earnings goes to the statement of changes in equity.
Revenue 563,800.
That we need. What is it? 563,800, I think you said, hey? Let me just double check. Okay, 563,800.
Yeah. Selling and distribution costs 36,120.
36. Okay.
Okay, share capital is owner's equity.
Yes, share capital is owner's equity, statement of changes in equity.
Trade payables is a liability.
Current liability.
Payments liability. Trade receivables. Current assets.
Current assets. Okay, so that's another one. Trade receivables. Brackets, how much?
71.
Okay. Great, last one. And then we need to look at adjustments. Wages and salaries.
Wages and salaries 48,000.
Okay, they haven't given you space here to write in a line item. So I think they will probably put this by selling and distribution, but let's just check it. Can you just pass the textbook there? The textbook did have an example last time. I can't remember which category they put it under, but we can just confirm.
Can't you just say, yeah, by expenses?
No, deduct expenses means?
The total.
Yes, okay. Here, income statements.
And under remuneration?
Well, that's director's remuneration, but director's special. Okay, these are salaries and wages. There, see, salaries and general expenses. They put it under admin. See that? Okay, so here in the textbook, they've used administration expenses as the grouping for salary and general expenses. See that? Okay, but then also look at this. Under selling and distribution, they've also put salaries. See, it's twice. It's salaries and general expenses, salaries here. So I think you've actually got options here in terms of where to disclose it. Personally, I would have shown this separately, but we can't, okay, because they said use the templates. So if we're going to use the template, I don't think that's an office cost, because salaries and wages could have been for people that are working elsewhere. Property, definitely not. So director's remuneration, it's only for the directors. It's not for other employees. Because did they say whose salaries and wages this was for? Well, they just said salaries and wages.
Salaries and wages.
Yeah. If they said salaries and wages for the directors, then we can put that here. Okay, so I'm not going to put that there because in the textbook they've used selling and distribution. They put a line item salaries there. I'm going to put salaries there as well. Okay, but I'm going to if you put it there, just say plus. What was the amount?
48,500.
48,500. Okay, then just asterisks and write down salaries and wages. Okay, just so they can see what that is. Because they weren't specific in terms of is this relating to the directors or is this someone else? Okay, I'm going to assume that it's part of the selling and distribution costs. Okay, we're going to pay people to sell and distribute the products. Okay, let's go back. Was there anything else there? No. Okay, great.
The value of inventory at the 30th of June 2017 was that at COP, so that's the closing.
Good. Okay, let's put that in. Bracket, how much?
70,300.
70,300. Great. Now we've got closing stock. Tick that. Let's look at the next bit.
Where's closing? I don't have. Oh, yeah, it's there. Just give me a minute.
Do you have more?
Just use this pencil.
Okay.
What was it?
So 70, 300, yeah, it's on the top there. Okay. Right, next. Tick, next.
So land and buildings, okay, we don't need that.
Next.
Depreciation is to be provided as follows.
That we need.
Okay, fixtures and fittings, 15% reduced balance method.
Yeah, see, there's a problem. Yeah, see, there's a problem. Depreciation, now where are you going to put that? Are we going to write it down separate? You have to actually show it separate. You should show it separate. So, the format is not great.
Because this is office costs, so we can just say yeah, minus.
Oh, charge. It says charge to. Okay, that helps us. Okay, so the question does describe where we need to put it.
Yeah.
Okay, then that's fine.
Yeah, 15% reducing balance method.
Okay, so furniture and fittings, 15% reducing balance method, and they said charge to office costs. Okay, so here by office costs, I'm going to say plus, open brackets. Reducing balance requires the carrying value. Okay,
so wait, this is fixtures and fittings.
Yes.
Fixtures and fittings we didn't use.
Go to fixtures and fittings. How much was the cost?
18,110.
18,110 minus what is the accumulated depreciation?
15.
No, go back. Provision for depreciation. 5,310. Okay, do you agree? If I take the cost and I minus the accumulated depreciation, I get the carrying value. Okay, why? I'm using what method?
Reducing.
Exactly. Okay, so carrying value needs to be calculated. Go back to the question. What is the rate?
15%.
Great. So we just times that by 15%. Okay, so I'm just going to put an asterisk here. The red is for the depreciation on furniture and fittings. Okay, so I've shown the working there. That's my working for it. Okay, because they said charge it to the office costs. 18,110 less 5,310 times 15%.
Okay. Buildings, we need to do that.
Yes.
Property costs, yeah.
Okay.
2% straight line.
2% straight lines. That's easy. So property costs here, we're going to say, what is the 135? Okay, the cost, that's good. Okay, so 135, 123 times how much? 2%. Close brackets. Okay, so I'm just going to highlight that in red again. And put a note here. Depreciation on property.
Motor vehicles, 25% reducing balance method to selling and distribution.
Okay, so here they've told us take it to this selling and distribution. Okay, and how much was the depreciation? 25%. What method?
Reducing balance.
Reducing balance. Okay, so we need to show that as well.
4,600.
Okay, so plus open brackets 4,600. That's the cost of the vehicles, right? Okay, minus what's the depreciation? 19,200. 19,200. Close brackets times what is the depreciation rate?
I think it was 25.
Was it 25? Okay, so just check that.
Yeah.
Okay.
So it's 5,600.
Right, so I'm going to highlight that as well.
Wages and salaries are to be charged as following.
Depreciation on vehicles. Okay. Yeah, what else do we have?
Wages and salaries are to be charged as follows. Selling and distribution costs 60% and office costs 40%.
Okay, so now we know how to allocate it. Okay, so remember earlier I was asking you, where am I going to put this, salaries and wages? Now I know.
So it mustn't go here.
No, it must go there, but how much must go there?
60%.
Exactly. Okay, so times 60%. Times 60%. I do think you should show these workings. Yeah, so maybe write it small or write it above or below, but somewhere. I think you should put that there. Okay. 4850 times 60%. Great, we've got that. Close the brackets. Right, so 60% of it went to the selling and distribution, and the 40% went to the office costs. Alright, so I'm going to copy that, and I'm going to show that here by office costs. Add 40% times that figure. Okay, there's the office costs. Right, that's the salaries and wages. Now we know how to allocate it. So that's good. Okay, see, they have to tell you that. If they don't give that information, then you're guessing. Okay, so this is a good question if they're very specific.
Baylis Limited took out a 5% debenture repayable between 2021 and 2025 for 50,000 on 30th of June and repaid the bank loan in full. Neither of these transactions had yet been reported in the book of accounts.
Okay, so we need to work out the interest calculation. So that requires a timeline. Okay, so let's do a timeline here. What dates did we have there? Read it again and just put the dates in. Okay, the first date that we need is the year end. What is the year end? 30th of June. Okay, so that's year end. Let's write that at the end here. 30 June 2017. That's the year that we're looking at. So 1st of July 2016 would have been the start. Okay, so I'm looking at a financial year that has that start and that end. Okay, let's read it again. B Limited
took out a 5% debenture.
When?
On the 30th of June 2017.
Can I see that actually? How do you know that was the 31st? Okay, alright, so repayable between 2021 and 2025, that's later on. Okay, so 30th of June, where is that? That's here actually. Okay, debentures. Okay, the debenture, this was a new loan. Okay, how much was the new loan? 50,000. Okay, and they say, and repaid the bank loan in full. Okay, so you took out a debenture to pay off the bank loan in full. Neither of these transactions has yet been recorded in the books of the account. Okay, so let's go back and check here. Okay, where's our bank loan? There's the bank loan. So the bank loan is gonna decrease because you're paying it off with the debenture. Do we have a debenture account here? Did we? I think we did, didn't we? No, the debenture was the other question we spoke about, yeah. So no debenture account. So basically, the loan account is going to go out and the debenture account is going to go up. Okay, but we need to look at the bank effects. Okay, so what would happen when you take out the debenture? You debit the bank, you credit the debentures. Okay, does that make sense? Cash coming in, loan going up. Okay. They told you that the debenture was going to repay the bank loan in full. Okay, so how much cash did we get? 50,000. Okay, how much is the bank loan? Debit the bank loan, credit the bank. Alright, so a portion of it is going to go out of the bank account. Alright, so that's what we need. Why? Bank could be a current asset now. Before it was a liability. Now it could be an asset. So when you looked at the question, we had bank, right? Just go back. How much was the bank figure?
The bank loan or the bank?
The bank figure. 14,000. Okay, so
overdraft.
Yeah, balance was minus 14,040. Okay, you've received money, debenture finance. Okay, how much debenture finance came in? 50,000. Okay, then you pay off the loan, the bank loan. Pay off bank loan. And the bank loan was minus how much? 26,400. 26,400. Okay, so do we now have a balance? Yes. So now bank is an asset, not a liability, so it will be disclosed. Asset now. Okay, I add up all of that and I get a balance now. Okay, so that's going to be shown, this little working here is going to be shown there. Okay, so we're going to add a line, bank, open brackets, minus 14,040 minus 14,040 plus 50,000 minus, what is the other figure? 26,400 minus 26,400, close brackets. Okay, so in the extract I need to show that, and that gives me an answer. How much? I want to add up with the bank pay. Let's minus this. Okay, that'll add up. Okay, there we go. Yeah, the 9560. That's right. This was the same figure. Let's just check. Yeah. Okay, so bank is actually an asset now because you received money from the debenture, you paid off some of the loan, you still have some cash sitting in the bank.
Makes sense. A payment of 12,040 is to be accounted for on property costs.
Good. Easy. Let's find property cost. There's it. Let's add another figure. Plus, how much?
1240.
1240. Small amount. Next.
An accrual of 2680 is to be accounted for on selling and distribution costs.
Okay, so an accrual. What accrual is it though? Is it accrued expense or accrued income?
It says an accrual.
Yeah, but selling and distribution costs, so it will be a liability, an accrued expense. Okay, so this is just revision from what we've covered previously. So I'm just going to show that over here. Accrual for selling and distribution. Okay, so what do? I debit the, it's an accrual, so an accrued expense is a liability, so debit the expense. Selling and distribution. Selling and distribution. Bracket expense increase, and then credit accrued expenses. Right, I'm obviously not going to record the accrual because that's a liability. I wasn't asked to do that, but I do need to debit the expense. So all I'm going to do is just add how much?
2680.
2680. Okay, 2680. All right, that's why. So that's the understanding. Obviously, I'm just adding it to the selling and distribution.
The directors require provision for doubtful debts to be created representing 2% of trade receivables at the 30th of June 2017 to be charged to office costs.
Okay, that's important. All right, so we need to raise a provision, charge to office costs. Okay, so
of 2%.
Yeah, but what was the
trade receivables?
Yeah, what was the total? Oh, you've got it there, 71. Okay, yeah. So trade receivables.
That's 1420.
Trade receivables, 71,000 multiplied by, what is the percentage?
2%.
2%. Okay, equals
1420.
Yes, agreed. Okay, where are you going to put that?
The office.
Yeah, so they told you charge to office expenses, right? So this is what you would have debited. You would have debited office expenses. Normally you would have debited what? Bad debt, right? Okay, but they're telling you to use office expenses. Then you would have credited what? The provision for doubtful debts. Okay, what's special about the provision for doubtful debt? It must be disclosed where? Against the trade receivables. Okay, so that 1420 is going to go here, office expenses, so plus, they did say office expenses, yeah they did. Okay, so 1420 goes there, don't forget to add it to your office costs,
Yeah, I did.
You did, okay. And then minus it from the trade receivables, minus 1420.
69580.
Yeah, that'll work out later because I might have to adjust it again depending.
No, it's done.
Is at the end? Okay, great. Alright, so that was the last of the question. Now just tally up. Okay, so obviously we've got two columns here, so I'm going to draw those two columns and then I'm going to show the totals. Okay, revenue didn't change. Cost of sales I need to work out.
So this is for the working amounts and these are the totals here, hey?
Correct, yeah.
So revenue will just go straight there.
This was a nice question, I must say.
Yeah.
It described everything very well and it covered almost everything. Okay, there was a provision, there was a bit of depreciation, there was an adjustment. So, yeah, I like this question in terms of revision purposes. It covers a lot of theory. Okay, different sections all in one question. Okay.
Just double check your amounts.
Yeah, double check your amounts. I'm obviously just adding them up here and then you can check. Just want to finish this first and I'll... Okay, finance costs. Okay, so that's the first part. Let's do the last bit here. 650. Okay, and that's it. Just remember that these two are negative, so don't forget to put brackets. Well, these three actually. Let's just make them red as well. That's a bracket, that's a bracket, that's a bracket, that's a bracket. Okay, those amounts need to be in brackets. Okay, nice question. Another one completes. Okay, I think we've got two more questions. Okay, and then we almost done. Okay. Question 3. There wasn't any theory for this one, hey? It was just disclosure.
Yeah.
A and B, that's it. Yeah, perfect. Okay. Sometimes they ask theory after this, especially in assignments. Okay, so question 3. Exam technique, look at the required. What do we need to do?
A. Prepare statements of changes in equity for the year ended 28th of February 2017. A total column is required.
Have they given you the template? Looks like they have.
But now there's no total column now.
Yeah, so I don't know what you're going to do. Do you want to add it there?
Is this for details?
Yes. Yeah, so total would be at the end there.
Then I'm going to add it here because it's nice to look on these templates.
Okay. Alright, so I'll redraw it. So let's put the columns. Okay, share capital. What else do we have? Share premium.
Is this details?
No, you don't write details, you just write in stuff, but it's blank as a heading. Retained earnings. Okay, perfect. So now you've got that. Is there anything else here? Hey, A, B. What does B say? We can maybe do both at the same time, same like the other one. Is that just theory? Okay, so all we need to do is just look at the information.
Okay, so the following is an extract from the Statement of Financial Position of Wells Limited on 1st of March 2016. Equity. Ordinary share capital at 0.50 each is 150,000.
Okay, what date is that?
Doesn't say.
1st of March.
1st of March, sure.
Okay, so 1st of March, just go back to the answer sheet. Yeah, the answer sheet. What's the year end? 28th of Feb. Okay, so do you have opening or closing here?
Closing.
Opening, yeah, because it's 1st of March. That's important, so we need the dates. Okay, so we're going to write down balance at the beginning of the year.
So that would go here, eh?
Yeah, at the beginning. Okay, what were those balances?
Okay, so ordinary share capital at 0.50 each was 150. Share premium account 60. Retained earnings 40. So we leave this, eh?
Yeah, nothing if they don't give you anything. What else do they give you?
So that's that done. Following additional information is available. On the 30th of April 2016, the non-current assets were revalued from the net book value of 175,000 to 25.
Okay, that's the revaluation. We need to do a calculation, NB. Okay, so what was it initially? This was net non-current assets, right?
Yeah.
Okay. Okay, so before, after. Okay, what was it before?
175,000.
And after?
225.
Okay, so the difference is going to be the revaluation. Okay, this minus that. 50,000 revaluation.
50,000.
Okay, so let's record that. Revaluation 150. Okay, so just want to see how they record it. Revaluation, they just write it down as revaluation. They don't specify what it is. I would actually write down what it is. Should get some tissue. Run out. Is there any more tissue here? Or?
No.
Okay, can I quickly run to the car and get? Okay, so you've got revaluation there, you've got before, you've got after. Revaluation 150. Okay, next.
On the 30th of June 2016, a bonus issue was made on the basis of 3 ordinary shares for every 10 held. Reserves were kept in the most distributable form.
Okay, so that's important. Let's look at that bonus issue. So, is it 1 for every 3, eh?
Basis of 3 ordinary shares for every 10 held.
Okay, so 3 shares for every 10 held. Okay, so we need to go back and we need to look at how much equity does this business actually have?
What do you mean?
How many shares does the business have?
150.
No, that's the rand value. Okay, so share capital equals 150,000. Do you agree?
Yeah, that's 0.50 each.
Yes, at 0.5 per share. Okay, so if I'm working out the number of shares, I need to divide. Okay, so 150 divided by 0.5 gives you 300,000 shares. Right, so now I'm going to be giving 3 shares for every 10 held. Okay, so divide by 10 times by 3. Times by 3. Okay, so this is what I'm going to be issuing. That's the bonus. Okay, so bonus shares equal, let's work it out, 300,000 shares, divide by 10 times by 3, 90,000 bonus shares.
Okay.
Okay, that you need to write down somewhere.
Yeah, well, I'm going to write it on here when you write it.
Okay, what did they say? How do they want us to record it?
On the 30th of June 2016, a bonus issue was made on the basis of 3 ordinary shares for every 10 held. Reserves were kept in the most distributable form. Okay, so the reserves, so they're saying the reserves are kept in the most distributable form, but that would have come from where? The retained earnings. So I'm assuming that what they're doing here is that they're giving more shares, but from the retained earnings. Did they specifically say revaluation reserve or not? They just said reserves, held reserves were kept in the most distributable form, Right, so from what it says, to me, unless, let's just check the bonus issue again. Do you remember which chapter we looked at it? I think you might have made a note for it, so you could probably check it quick on your file there. Okay, here's bonus issue. Found it. Yeah, they did use the retained earnings. Okay, so I'm going to use the retained earnings. They did that in the textbook. They're probably going to use this as well. Okay, because here they debited, see, debit reserve account, credit the share account. See, reserve account. So that was the revaluation reserve. But you see, it's the revaluation reserve, or you could debit the retained earnings. So just an asterisk here. You could use retained earnings or the revaluation reserve. Okay, so because they've said debit reserve here, I think let's use the reserve rather than the retained earnings. But you could have used either or. The net effect would have been the same. Okay, so how much am I going to issue? 300.
90,000 shares, bonus shares. Okay, how much are these shares worth?
0.50.
Okay, 0.5 equals Okay, 45,000. Alright, so let's write that in. I think they just write down issue. They don't even write the word bonus. You should be more descriptive, but if they've just done it that way, here they just said share issue. Let's use bonus share issue, just to be more specific. Bonus share issue. Brackets, 3 shares for every 10 held. This you could get marks for. This you could get marks for. So maybe that, just write it down underneath it. Okay, as a working. So what working could you show there? You could show this in bracket or asterisk. This is the working. 150,000. I'm just writing down what we wrote down. Divided by 0.50 equaled 300,000. Okay, then we said 300,000 divided by 10 times by 3 gave us 90,000. Okay, then we multiplied that by 0.50, which equaled 45,000. Right, they might give you workings for that calculation, so it's worthwhile to show it just in case. Okay, so 45 is going to come out of the reserve. So on that line, minus 45,000 in brackets.
Okay.
Sorry. Next. Last bit, eh?
Okay, so on 30th of September 2016, a rights issue was offered on the basis of 1 ordinary share for every 8 held.
Okay, so here's another one of these issues. Okay, so 1 share for every 8 held.
The ordinary shares were offered at a price of 0.80 per share and the issue was fully subscribed.
Yeah, but now what date are we sitting at?
30th of September 2016.
The bonus issue, what date was that made? Because we might have to take the bonus issue into consideration. What was the date for the bonus issue?
30th of June.
Okay, yeah, so that does make a difference. Okay, so let's write the date here. 30th of June, next to bonus issue, and then this one is 30th September. Okay, so obviously September is after June. Alright, so now I need to look at, well, how many shares? So shares to date equals, I had 150,000 shares. No, I had 300,000 shares. 300,000 shares plus the 90,000 shares equals a total 390,000 shares. Okay, in terms of the amounts, okay, the shares are at $0.50, 50 cents. Okay, so that times 0.50 is 1950. That makes sense. Okay, 150 plus 45 gives you 150. That's the rand or the dollar amounts, and that's the shares. Okay, dollars. Okay, so now we know that based on what they've said here, on 30 September, so here, I'm going to be giving 1 ordinary share for every 8 held. So divide this by 8. Okay, divide.
And a share price of 0.80.
Yeah, so the share price, so the equity will be worth more. So divided by 8. Okay, times by 1. Okay, so let's see what we get. 390,000 divided by 8 times by 1 gives you that number of shares at a price of how much? 0.80. 0.80. Okay, so the equity that you're going to be issuing in the rights issue is this. Okay, let's highlight that because that was an answer. Okay, let's highlight that. So that would have been 48,000 shares times 80 cents gives you $39,000. Okay, that's the dollars. Right, so there we go. So now we've got the shares and we've got the price. Okay, so again, this little bit you need to write in somewhere just to show the working. But let's just record it then. What did they say?
Bonus share gain.
No, not bonus share. This is a rights issue. Offered in the price. Did they say, okay, this you could probably use the retained earnings, okay, because you're not going to be affecting the revaluation. Okay, so for this one, I'm going to use retained earnings. I'm going to write it down here. So rights issue. In brackets, you can show a working. You can say 300,000 plus 90,000 equals 390,000 shares. Okay, divide by 8 times by 1 equaled, what is it, 48750. Equals 48750. Okay, so that was the first bit. And then the last bit was just to take the 48750, multiply that by 80 cents, gave you 39000. There's it. Okay, so all I'm going to do is show that into retained earnings. So where's my rights issue line? There's my rights issue line here, minus 39,000.
Okay, can I just say?
Okay, minus 39,000. So I've just shown the working there. Yeah, working should carry value or amounts, or, well, what they're probably going to do is probably look at your answer. If your answer's right, tick, great. If it's wrong, they'll probably look at this and then give you maybe a half mark or a mark depending on that. Okay, but yeah, I mean, we've read it correctly. My only concern is this, the columns. Do I use the retained earnings or do I use the revaluation reserve? Okay, you could have used either or for the bonus issue and the rights issue. It just depends on how the company is going to be paying out these bonus or extra shares.
Shares, what is this line?
Divide by 8. Divide by 8. Yeah, that's the divide sign on Excel. Divide by 8 times by 1. He gave you the 39,000. The 39,000 is going to come off the retained earnings.
Okay. Retained earnings.
Bracket 39,000.
Okay.
Next.
On the 31st of December 2016, the company paid a dividend of 0.04 on all shares in issue at that date.
Yes, okay, so now, again, we need to just write a date here. So that was 31st of December. Okay, so total shares to date. Total shares to date would equal this, the 39, plus the rights issue, plus that. Okay, so that's the total number of shares. Okay, it's the 390,000 plus that. So let's write that down. Ordinary share dividends, brackets, 390,000 shares, or 390,000 plus 48750 equals 438,750 shares. Okay, then we just need to times that by. So 438,750 times, how much dividends do I pay? 4 cents, 0.04. 0.04 equals a dividend. Let's work it out down here at the bottom. This times 0.04 gives me that as a dividend. Okay, so 17,550. 17,550. 17,550. Just double check. Yeah, 17,550. Okay, so where is the ordinary share dividends going to come out of? The retained earnings. That will definitely come out of there. Okay, so minus 17,550. Dividends paid. Maybe just add the word paid here. Ordinary share dividends paid. Okay, because you have paid this. They said it was paid. It wasn't distributable, hey? Let's read it again. All shares in issue. Yeah, they said the company's paid a dividend. So that's fine. Okay, good. And then we've got literally one line left. What does the last line say?
Profit for the year ended 28th of February 2017 was 5,500.
Okay, that's a nice easy one. Profit for the year. Okay, profit for the year will go to retained earnings, and the amount was 5,500. 5,500. That's it. Okay, the last bit is just balance at the end of the year. Okay, so we need to put a total line here. Okay, and that's the balance at the end of the year.
You said beginning there.
Yeah, I just copied it, so I'm going to change it now. Okay, end. Okay. Alright, so all I need to do is I just need to show the amounts that I've owed. I also need to change the share capital, so I just left out this. Okay, so remember this bonus here that we had? Revaluation, 45,000. That was the 45,000. We need to show that here as well. Okay, because you're paying it out of the revaluation, you're showing the share premium. Okay. Alright, that was the 50 cents. Okay, just add that. Wow. Okay, it's going to rain again. 45,000. Okay, and then I need to do the same thing with this, the rights issue, see that there? Okay, but be careful with the rights issue. I'm just going to go down to my working and show this. Do you agree? This was at a price of what?
0.80.
80 cents, exactly. So that means this $39 is going to be split between 50 cents, which was the par value, okay, and 30 cents, which was the premium value. Right, so I need to show the split here, just for the amounts, just so I can show the amounts. Okay, it needs to be split like that. All I need to do is just show that percentage split, so 39,000 times 0.5 gives you that, and 39,000 times 0.3 gives you that. So this is the share premium, and this is the share capital. Okay, so that needs to be split only because it was 0.8. 0.8 is more than 0.5. Do you agree? Okay, so 19,500. On the line that you had this, the 39, just put here 19,500. Okay, and then the share premium, what is the other figure? 111,700. 11700. Okay, so coming back to this, 11700. Those figures don't add up to 39. I've made a mistake with my calculation. Oh, it's a percentage. Sorry, divide by 0.8. Okay, divide by 0.8. Divide by 0.8. Okay, that's better. So this should have been, okay, divide by, where's the divide sign? Yeah, divide by 0.8 gives you that. Divide by 0.8 gives you that. Okay, let's just check. Does that add up to, sum up those two? Does that add up to 39? Yes. Okay. Alright, so yeah, just fix that. It should be 24375. 24324. Let's just reference it actually. Yeah, it's probably load shedding. Okay. Alright, so share issue, that equals this amount, there, that one, and then that amount is this one over there. Okay, that's better. Alright, so we just needed to fix those figures. If I add up those two amounts, then I get the 39. That's correct. Alright, the last bit is obviously the profit, which is fine. Now it can tally up. Okay, so equals the sum.
What are I'm getting totals on the side?
Yeah, just now. Let's add up the totals at the bottom first. Sum up all of that. Sum up all of this. Okay, sum up all of this. Okay, reserve, you would put a 0 here. And then sum of that, and then the totals. Okay, so this total column here at the end is the totals, but the totals on the lines. Okay, so this one, I'm going to sum up these three. Okay, and then I'll sum that up for all of them. Sum up, sum up, sum up, sum up, sum up, sum up. Okay, so it's basically the total or the sum of the amount that you've got. Okay, for the actual balance. That's the end. Oh, we're doing really good today. Time-wise, wow, these are going quite quickly. The blinds are open. Can you still see it's a bit dark on your side? Okay, let's answer the theory question then, and then we're done with this question. Okay, we can do the last one, I think. Well, how many is there? Is there 2 more or 1 more?
Question 4.
Okay, there's 2 more.
And question 5.
We'll see how long question 4 is. If you don't mind, we can maybe do it today, depending on the time. And we can just finish 5 next week. Okay.
Okay, so B, state 3 advantages and 1 disadvantage to a limited company of making bonus issues of shares.
Okay, that's purely theory. That we can just reference in the textbook. I had it here now. Where is it? Big bonus share issue.
So I'm going to say advantages. Advantages of bonus shares of bonus.
Okay, so there's limited theory in the textbook, but they do give you a table here, and you can use that. Rights issues and bonus issues, that was what we mentioned previously in terms of the theory. So they do want you to answer this relating to the theory. So they wanted...
Advantages of bonus shares include...
Okay.
Bonus share issues include 73 advantages.
Alright, so if we look at a bonus issue, you can say a bonus issue will reward shareholders for having invested in the business. Okay, because this is looking more at the financial management, right? Can I just read the question myself just to make sure that we are focusing on the right bit? Okay, state 3 advantages and 1 disadvantage to a limited company of making a bonus issue of shares. Okay, yeah. So an advantage would be to reward shareholders for having invested in the business. That's good. Okay, that's positive. Okay, you want people to feel that, okay, we invested in the company, we got something back for that investment. Okay. Second advantage could be
increasing capital.
Increasing share capital. Increasing the share capital by issuing more shares. Okay, let's think of one more. Let's see if there's anything else we can maybe comment on in the question or in the theory, the textbook. Okay, they also said directors may redress this imbalance if the shareholders agree by transferring some of the balances on reserves to the ordinary share capital account. That's what they said. So you could also say, this is on page 253.
So
let's summarize it.
Also,
yeah, you can say
bonus shares also.
Yeah, directors can transfer amounts from the reserves to the directors can transfer amounts from the reserves to the share capital account. Okay, there's your three advantages. Right, that's advantages. We need one disadvantage. Okay, a disadvantage could be if you're giving away more equity. Oh, I see another advantage here. The control of the company does not change. It remains with the existing shareholders. That's another one. Let's add that.
I've already said a disadvantage may include.
No, can you not? Oh, yeah, you can't add it here. But I'm going to add it here to this. Increasing the share capital by issuing more shares. Can you put a bracket there maybe?
Where?
Here, issuing new shares. The second one you wrote.
There's no space. It's fine. We gave 3.
But this is a good point, eh? I just want to put there no.
Put at the end. I'll do the disadvantage then.
No change in control. Yeah. Okay, the disadvantage. In terms of a bonus issue. Okay, so if we're looking at the actual bonus issue, you're giving more shares away. A disadvantage to that.
More expenses, dividends.
Possibly, yeah, paying out more dividends because there's more shares. Okay, that's a good one. Let's write that one. Okay, so if more shares have been issued, comma, we will pay dividends on a greater number of shares. Okay, so that's a good point. Let's just think. Okay, they asked for 1, so I don't think you need to write more than that.
Let's say that advantage.
Yeah, just the advantage. The advantage was here. I see they said the control stays the same, but it relates to the issuing of shares. Okay, so point number 2, we wrote down increasing the share capital by issuing more shares. I just wanted to add that.
So another advantage will include that
the control does not change. The control stays the same. Does not change, yeah, stays the same. Alright, so just additional theory here, which is in the table. Okay, that's good to write. Okay.
Question 4.
Right, so what is 4 looking at? Is 4 theory or is 4 calculations? Let's have a look. It's 4 marks. Okay, and there's more. That one. There's theory here, looks like it.
Okay, required. A. Discuss the impact of each option on the future profits of A Limited. 2. Advise the directors which option they should choose. And then B. Explain the difference between capital reserve and revenue capital.
Yeah, so that's just, it's a nice one. It's just looking at 2 transactions. Okay, so let's look at each of the transactions. Obviously A1 Okay. A1 said, discuss the impact of each option on the profit, the future profits. Okay, so impact on future profits.
Okay, so A Limited issued $80,000 5% debentures 8 years ago. The debentures are due for repayment in the next 2 years. The directors of A Limited are considering the following two options to raise the necessary finance to repay. So they're considering the following two options to raise the necessary finance to repay the $80,000. Number one, issue 160 ordinary shares at 0.50 each. Issue a further debenture of 80,000.
Yeah, so they're saying what would that impact have on the future profit? So we need to look at each one. So option one or transaction one. Option one said issue 160 ordinary shares of that each. Okay, so if you're issuing more shares, you would have debited bank, you would have credited share capital. Is this going to affect the profits? No, it won't. Okay, this won't affect future profits. Okay, if I issue more shares, it's not going to affect the profits. It'll affect the dividends possibly. So this option will increase the ordinary share capital comma bank will increase bracket more cash. Okay, the first bit we can comment on because they said you were going to do this because you wanted to repay the debentures. Okay, so if I'm issuing more share capital, I'm going to get more cash. Do you agree? That cash is going to be used to pay off. They said the directors are considering the two options to raise the 80,000, and that was the debentures. They're going to be paid. Okay, so when we pay back the 80,000 debentures, comma, there will not be any debt, comma, only equity. Okay, so in terms of future profits, equity does not charge interest, comma, future profits will be higher because there will not be any debentures. Okay, so basically, if I just summarize, this company has debenture finance. Okay, 80,000. 80,000 is a loan. What are they going to do? They're going to issue shares so they can pay off the loan. Right? If they pay off the loan, they don't have a debt, they don't have a liability, but now they've got the equity. Okay, so now they've got shareholders that they need to pay a dividend. Okay, but a dividend is going to be paid out after profit. Okay, we can just mention that last bit. Shareholders will be paid a dividend, but this is a payout of the profit after taxes. Okay. Right, that's A1. That's option one. Okay, so we've described the first option. Let's put a heading option 2.
Issue a further debenture of 80,000.
Yeah, so that's obviously going to reduce future profits. It's the opposite. Okay, so all we need to say there is if we issue more debentures, comma, there will be more liabilities. Liabilities will incur interest. More debentures means more interest.
This will increase the business's liabilities, increasing
Okay, so liabilities will incur interest. More debentures means more interest expense. Therefore, future profit will be lower. Okay, that's 2. Okay, so A1 complete. A2. Advise the directors which option they should choose. Give reasons for your decision. 3 marks. Okay, so which option would you choose? This is kind of like an open-ended question. You just need to give reasons. You think one is better?
Yeah.
Okay, why?
Because your profits are going to increase.
Okay. Right, so if they choose option 1, then we need to focus on option 1. So, issuing...
What do you think?
Yeah, either or is fine. It depends how you motivate it. Okay, so both have pros and cons.
So can we say option 1 is better?
Okay, see, the thing is, I could say that I would rather go with option 2. Why? Because I don't want to give away ownership. See, that's the whole debate. Okay, do you give ownership away, or do you take out more loans? Okay, so again, it's up to you.
Just with this, there'll be more expenses.
There'll be, well, yeah, well, there's more expenses, but at least you still own the business. Yeah. Okay. All right, issuing.
Okay, so option 1 will be a better option as
ordinary shares
issuing
to remove the debentures, brackets, less liabilities, less interest, more profits. Okay, I'm just summarizing. You can write it in a paragraph if you need to. Okay. Right, it's out of 3, so I think we need to give a bit more. Yeah, give reasons for your answer. Let's think now. If I'm going to be issuing share capital, you could talk about benefits of issuing share capital. So you can say, by having equity, bracket, ordinary shares, comma, we are not obligated to pay a dividend. Okay, companies can choose to pay a dividend or not. They don't have to pay any dividend if they don't want to. Okay, remember, companies sometimes keep profit so they can grow. But if I take out a loan, do I have to pay interest? Yes, I do. So that could be an advantage as well. It could be a reason why you would motivate them to do it. Okay, so by having equity, ordinary shares, we are not obligated to pay a dividend. If we had more debentures, comma, we would have to pay interest. Pay more interest. Right, and that's obviously another motivation. Okay, let's try to think of anything else. Something else you can maybe use. Let's see. Ordinary shares. Why would you rather want them to pay it off? It might be cheaper actually. You could be saving. So the dividends that you would pay could be less than the interest that you would pay. Alright, so that's also something you could say. The cost of ordinary shares could be less than the cost of debentures. Okay, but just be careful of that. Obviously, you're not looking at things like taxes, okay, but taxes actually can help the business, because if you have a bigger expense, you can claim it as a deduction. Okay, that's more advanced. Okay, so I don't expect you to know that or provide that here. I don't even think they'll have it in the answer. Okay, so let's just leave it as is. But there actually is a benefit to debt. Debt is actually good for companies. Equity is actually not that good, but that's different. Okay. Right, then we've got one more question, and then we're done. Explain the difference between capital reserves and a revenue reserve. That we've actually done in terms of theory previously. I think we even wrote a summary for it in the... Yeah, here's it. Yeah, we did. Page 247. You have a note for it in your notes. Right, so I'm going to just put a heading here. Capital reserves versus revenue reserves. Okay, this came from page 247 to 248. It was chapter 25. You probably wrote something about it there. Let's see. Public-private companies next. Income statement. Ordinary shares. Revaluation reserve there. There's the revaluation reserve. Statement of financial position. Next.
Yeah.
There you go.
Okay. So capital reserve.
Yeah, so what is a capital reserve? Just to revise, this is what the textbook says. Capital reserves arise from capital transactions and adjustments to the capital structure.
So they said this is when a company carries over profit from operations. That's what I have here.
Which one is that?
Capital reserves. Revenue reserves, sorry.
That's the other one. Yeah, I'm wondering. That's not right. Yeah, it's the other one.
Okay, so we'll do revenue reserves first.
Okay. Maybe just write the definition as is. Okay, so I'll just read it out and you can just write it down. Okay, that's what I'm doing here as well. So capital reserves arise.
Okay, so capital reserves, this is when?
This is when a reserve arises. Okay, we're just rewording it because you've got it there. Okay, capital reserves arise from capital transactions. Capital transactions and adjustments to the capital structure of the company. Okay, that's the definition. What did they say? They said, explain the difference between capital and revenue reserves. Yeah, so we need to define it. Okay, so the textbook gives you that definition. Okay, then I'll read out the definition for the other one. We'll write it down as well. And then we'll just say 2 notes about the differences. Okay, because it's out of 4 marks.
Okay.
Okay, definition for this one. Revenue reserves. Revenue reserves are profits that are retained in the company to strengthen its financial position. Okay, that's the first sentence. The definition goes on. They are normal profits that have been retained. They are normal let's just add the word normal operating profits, okay? Because here the textbook obviously puts a bracket and they talk about that. So they are normal brackets or normal operating profits or profits that have been retained. That have been retained. Okay, then the last sentence is, this is added to the retained earnings from previous years in the statement of changes in equity. This is added to the retained earnings from previous years in the statement of changes in equity.
To the retained earnings.
This is added to the retained earnings from previous years in the statement of changes in equity. Okay, that's the definition. Okay, so we should get 2 marks for those definitions. They came straight out of the textbook. If they're asking you to explain the difference, well, let's write down 2 points just to give a difference. The textbook's actually quite good because they say the main reserves that you could encounter are retained earnings, general reserve, non-current asset replacement. Then for capital, they give you the other ones. Okay, that's the difference. Okay, so let's write that down. Okay, capital reserves are 2 dots. Okay, let's list them. Capital reserves are share premium, comma, there's 3. Revaluation reserve and capital redemption reserve. Okay, those are the 3. Okay, so let's use it as one sentence. So you've said capital reserves are share premium, revaluation reserve, and capital redemption reserve. Whereas the revenue reserves are, because see, this is the difference. Okay, the revenue reserves are as follows. 2 dots. Let's list them. Okay, so the first one, retained earnings. Retained earnings, comma, general reserve, and the last one, non-current asset replacement reserve. That's the last one. Okay, so there's really a difference. Let's see.
I think that's enough. That's a lot.
If we're following, yeah, so we've got 2 definitions. We've got 1 note there. I would think we need to put 1 more point because of the 4-mark indication. Here they said revenue reserves are most flexible. So the one is more flexible and the one isn't as flexible. Okay, so let's write that down. Revenue reserves are more flexible. When recording them. Okay, that's it. Right, and that wraps that up. Okay, so we'll finish question 5 next week. It's short, doesn't look too long. If you want to, you can even try to do it because here they talk about ordinary shares, ordinary share premium. We've done quite a few of them now. Okay, so depends on how you feel. If you want to do some work in advance, I know you were asking about like past papers and things like that. You could try assignment question 5. We'll discuss it and we'll look at it together and we'll check what you've done if you do have a chance to do it.
Okay, cool.